This is InvestTalk. Independent thinking, shared success.
This is Marcos Luna from Coalinga, California, and I'm calling about ticker symbol CPA. Copa Holdings, it's my take on the airlines. I know this is a South American-based company, and I just wanted to know, is this thing a strong company for years to come? Can't wait for your answer. Thanks for all that you guys do. Have a good day.
All right, looking at Copa Holdings. It's a provider of airline passenger cargo services through its subsidiaries, and it is out of Panama, okay? And 82 destinations in the Americas, both North America, South America, and Central America, and the Caribbean, okay? Now, here's my issue. If I look at the stock chart, it's gone nowhere. Since 2012, it's trading at 90. It's trading mid 2012. Sorry, not end of 2012. It's trading about $100 per share. Now it's at 101. And if I look at earnings have gone up, but the stock's kind of gone nowhere. 6% yield. It's obviously operating in a more volatile environment. But the valuation is certainly cheap. So this would be definitely a good example of a name that you would want to, if you have confidence in the economies of Central South America and their political stability, then this would be the type of name that you'd want to own. Now, that's why it's paying a 6% yield. So I wouldn't be buying it because of that yield, because that yield can definitely ebb and flow. Let me look at the last dividend amount. Yeah, right now it's $1.60, but it was 82 cents last year. And it was back in 2012, it was $2.25. And then it dropped all the way down to 51 cents. So don't be buying this because of the dividend, because that dividend clearly over the last 13 years has been very volatile. So it's not one of those names you just clip the coupons and you're good to go. But if you look at profitability, return on equity is around 26%. It's about where it's been for the last decade plus. So I like that. Nicely profitable. About $1 billion in free cash flow on a $5 billion enterprise value. That's pretty good. And what is it doing with that cash flow? It is, pull this up here. It's buying back shares. I like that. So I'm fine with this. It's some debt, but about $1 billion on $4 billion market cap. That's nothing crazy, about 20% there. I actually kind of like it. Now, let me take a look at the chart here. Pulling up a weekly chart, and it's just been consolidating. It's kind of neutral from a technical perspective. It's not bad. It's not great, but it is a good value. And this would be a way to play the potential rise of Central and South America. You know how I feel about Mexico. I do think Mexico has a good demographics and has some nice longer term secular tailwinds. And this has some exposure there. So if you're going to buy an airline company, this is probably the type of company I would buy. So CPA, I'm giving it a thumbs up. Let's head to a voicemail call right now.
I would like to get your take on waste management stock, WM, and looking to get some exposure in the industrial space. I was wondering, A, what you thought of the company as a long-term hold, and B, if you thought it was a favorable outlook, what you thought a possible entry point would be. Thank you.
All right, looking at waste management. Most people know what waste management is. It's one of the largest waste collection companies in the world, both collection, disposal, and recycling service here in the United States and in Canada. About $89 billion market cap. They do have a good amount of debt on their balance sheet, about $24 billion. Okay, and you have return equity around 34%. So that's nice profitability, although it does look like that profitability is rolling over just a bit. They buy back shares, although those buybacks have slowed down. Free cash flow about $1.8 billion. That means that the free cash flow yield, frankly, not that good. Only about 1.5% from an enterprise value perspective. Enterprise value to EBIT around 17.5. Historically, that is on the high end of the range. that it's traded at over its life ever. Okay. So, while I like the business, I love the profitability, I love the consistency of the business, I just think it's too expensive. And growth is certainly slow. This year, earnings are supposed to be only up 6%. And last quarter, earnings fell 5%. The quarter before that, earnings fell 2%. So clearly, they're having some margin compression problems. And if you look at the chart on a weekly basis, it is starting to show some momentum waning. So I would be very, very patient on Waste Management. It absolutely should be on your watch list. It's just a bit expensive compared to the market, as well as, most importantly, compared to itself and how it historically trades. So I would be looking for a pullback at least to 180. Right now, it's trading at about 222. So I think there's about a 20% downside to this name before it gets reasonable from a valuation perspective. So I'm passing on Waste Management for now, but absolutely keeping it on my watch list. Now, we get questions submitted over on our YouTube channel, and Puchadam, I love that name, Puchadam, says, I was wondering if you could take a look at Carl Zeiss Medic's CZMWY. Let me take a look at this. Pull this back up. I'm in the field and love their products. I think they're incredible for research, especially their X-ray imaging techniques. Curious about any insights from the business end. Don't own any, but want to see if it's a good long-term investment. All right, Carl Zeiss. This is one of the largest medical technology companies in the world. It has two segments: ophthalmic. That's how you say it. Ophthalmic devices and microsurgery. All right, 75% of sales in 2022 were on refractive laser and surgical devices. So you're thinking I'm thinking the LASIK space. One of the best stuff. I think I spent about $4,000 back in. This is about 15 years ago. I had LASIK, best money I've ever spent. So certainly love their products, but this stock has declined pretty considerably from its all-time high, which is, let me pull this up here. I have so many systems. This is all-time high around $240 per share back in 2021. It's pulled back to $69. So the technicals are not great. They're definitely not great. But if you look at the business, very little debt, pretty good cash flow, about $239 million in free cash flow. And that's stayed relatively consistent. And let's see, are they buying back shares? No, they just started to buy back shares a little bit. Modest dividend, only about 1% dividend yield. Overall, I like the business that they're in. I like the balance sheet. I like the cash flow. I worry about the chart, right? And the chart needs to improve. The technicals need to get a bit better. But overall, if you're looking from a long-term perspective, I kind of like it. I kind of like this play. That's Carl Zeiss Medic's. CZMWY is the symbol. Very, very interesting name. All right. Let's go talk to Dan. And he's in Walnut Creek looking at Agnico Eagle.
Hey, Justin.
Dan, you there?
Yes, I am. Can you hear me?
Yes, I can. So you're looking at Agnico Eagle.
Okay, great. Yeah, and Franco-Nevada, FNB.
Okay. Obviously, these are...
So my question...
Good.
Go ahead.
No. What's your question?
Okay. So, they've been doing really well for me. And recently, with the stock market, kind of recovering, they've been going down since, I think, about the 6th of May. Mm-hmm. And I don't know if that, people are using these stocks, gold-related stocks, as like a hedge for the uncertainty of the market. And maybe that's why they're going down now. People are getting out and buying individual stocks.
Well, part of it is those overbought. I said this a few weeks ago. I said callers on gold, and I said there was a cover of Barron's talking about gold. That's usually the death knell, at least in the short term, and that's definitely been the case here. It's pulled back. But overall, if you look at GLD or GDX, the gold miners, they're still in an uptrend. They're holding all the major moving averages, and this just pulled back to pretty good support here in around these levels. Now, will the support ultimately hold? We shall see. But this is the nature of investing in the miners. They are volatile. They will go up 30% and fall back 20% in short order. And you've seen this with Agnico Eagle, right? It peaked out around 126. Now we're at about 105 or so. That is normal volatility. You look at the broader, the broader trends are still positive. It's still making higher highs and higher lows. This is called owning commodity names. So yeah, nothing to worry about right now, and it is into some support.
Great. Thanks very much, Justin.
No problem. Thanks for the call. Let's talk a little bit about a recent piece. This is from Mohammed El Arian, one of my favorite market commentators, and it kind of echoes what I said at the top of the show in many ways, but he, as usual, says it a bit better than me. And what he talked about was that we've had a wide volatility in market sentiment around the U.S. economy in just a short period of time. So he talked about how American exceptionalism was all the rage just in January at the World Economic Forum. And then April, we had the fragmentation of the global order, and the mood on the U.S. economy soured considerably. Now we've had a rebound in equities. The trade war, at least the narrative, is behind us, even though, we're still dealing with 30% tariffs and 10% tariffs everywhere else. And, there's still a relatively elevated level of tariffs but most people are not really talking about. The narrative is behind us. So you had that volatility of the narrative. You had the VIX with a wild roller coaster. And the yield, which I think are underappreciated, the yields on the 10-year and the 30-year, moving wildly without any Fed move, right? The Fed has not made any changes this year, at least their policy rate. Then a little changes to the QT, right? Quantitative tightening at the margin, but nothing dramatic. You've seen the dollar reverse, heading to a downtrend, and the normal correlation between a strong dollar and lower treasury yields, that is kind of broken. Now, part of this is policy volatility, and that's creating wild swings in consensus narratives. But what's really happening under the surface is a shift in global economic structures. And the failure of individual companies, this is what he says, the failure of individual companies to grow in a consistently strong, inclusive, and sustainable manner has increasingly pulled the rug from under traditional economic management tools. I love that quote. That the growth that we've had for many decades has not really been inclusive. And that you have to think about the direction the global economy is going as a new direction. We're not going back to the old normal. And we're venturing into more uncertain territory. And that just comes with the territory of investing. Economies shift, economies go in cycles, markets go in cycles. And the reliability of U.S. financial markets as the place to go for savings is no longer there. It's not the go-to anymore, at least not as much as it was before. So it's important to have this perspective and to adjust your thinking accordingly. We talk about this all the time, about how we're not here to give you a tip on a stock. We're here to help you understand principles that will guide good decisions. And part of it is not using emotions. But part of it also is to correctly assess the reality on the ground. And the reality on the ground is seeing through the headlines, yes, but also stepping back from the headlines and understanding the world around you that the headlines exist in. That this is a feature of the new paradigm that really was ushered in, like I said at the beginning of the show, starting with COVID, or starting with the financial crisis, but accelerating with COVID. And so hoping for calm is not a strategy. Understanding that this moment is something that requires corrective action from governments, from companies, from international leaders to solve a problem that has been building for many decades. And whether you love President Trump or not is irrelevant. But what you have to understand is that this is not just an American phenomenon, it is a global phenomenon. Let's go take a live call from Bill in Northern California looking at EQIX.
Yeah, could I ask you a quick question before that?
Sure.
You covered that stock is about your, you mentioned your watch list. So I'm just curious, what kind of watch list do you have? Whether you have like separate watch lists or just one general watch list that everything that you are looking at is in, and how do you categorize them? How many stocks do you have in your watch list or lists altogether?
Well, there's sector watch lists, and it's different between sectors. There's some sectors only a handful, other sectors there's 30, 40 names that are very interesting and high quality. So, and then, it depends on what weighting we want within a particular sector. And then we will go in, and do we need a higher weighting? Do we add to current positions, or do we find a new one and we dig back into that watch list and try to figure out which one has the best setup over the medium to long term. So that's kind of how we set up our watch list.
So how many stocks in your watch list altogether in total, would you say?
Oh, geez, because like I said, it varies between sectors, 11 sectors, probably combined. I haven't counted them as of late, but definitely over 100, probably between 100 and 200, somewhere in that range. I can't speak to exactly the number.
Yeah, that's all I was asking. Thank you.
No problem.
Anyway, regarding Equinix, I have this position. In the last several years, I've bought it, much lower and sold it, and then it went back down, and I bought more. I have a small to medium position, I would say, for my portfolio. It seems like a dividend growth. They've raised their dividend consistently. I heard somebody on CNBC, I forget what his position was, older guy talking about in his funds or whatever, they were like shorting it as a hedge because of this sector of REIT type of data banks is like maybe not going to do as well in the future when these new AI things come up or something. But it seemed to me like a pretty good long-term growth story, and that's how I have it.
Yeah, I mean, there's definitely some tailwinds. There's some challenges going forward with AI, whether it's been over invested in or not. But in general, right, the good thing about Equinix is their revenues continue to go up and profits continue to go up, or funds from operation, because they're a REIT. So I have no problem with it, but it's certainly expensive compared to most other REITs. Now, let's go take a question from YouTube. Pull this up here. Says, Raptor318 says, hi, Justin and Luke. Peter from New York, longtime listener, and value your frank opinion about stocks, the market, and most importantly, the proper mindset to be a rational investor. I'd like to know what your opinion is about Dutch Bros as an investment. I do not own the stock and would like to see if it's a good stock to add to my portfolio. And at what entry price, I definitely see it as very expensive, but they do have an aggressive expansion plan. All right, let's go look at Dutch Bros. I believe the symbol, he didn't list it, but I believe it's BROS. Yep, there we go. BROS is the symbol. And this is a company that operates 982 drive-through coffee shops in 18 states in the United States. And it's supposed to earn 59 cents this year, 81 cents next year. Last quarter revenues were up 29% and earnings were up 56%. But it's trading at $72 per share. So even based on next year's earnings, it's nearly 100 forward-looking multiple, P multiple. That is quite expensive. Price sales ratio is 6. Enterprise value to EBITDA is at 43. Very expensive. The good thing is they do have they have a good balance sheet, pretty much no debt. But what are they doing? Is they're issuing a ton of shares. And their free cash flow, only $32 million. Now you could say, hey, it's positive now after being negative. They're putting the money into growth. And I certainly understand that to a degree. I've seen this picture though before where you find a popular model for a restaurant, and it might be new, it might be different, it might be cool, it might be something that fills a need. And you get investments, you go public, like Dutch Bros did recently, and you put all of that money into new products or new stores, excuse me. But they overgrow. They grow too fast. They cannibalize themselves. They put stores in places that don't make sense. And eventually, there's too much misallocation of capital and things collapse. My most favorite example of this, there was one in the 90s. It was called Boston Market. It was very popular here in California. There's still some around, but it's much smaller than it was. But it was really popular in the late 90s. And that was their problem. They grew too fast. And I think you're going to have the same problem with Dutch Bros. And I wouldn't be buying it at these valuations. Like I said, forward-looking multiples of 100 typically are hard to grow into. Now, if I'm looking at a chart, it's in an uptrend. It's trending nicely positive. So as a momentum play, sure. But I find it difficult to believe that they're going to be able to grow into a $9 billion valuation. The $9 billion valuation puts their free cash flow yield at 0.3%. And they're issuing more shares. They're using the current price as a piggy bank to go and get more cash flow to spend on expansion. And so if you look at cash from operations, it has been improving. Let me take a look here. But it also is leveling out. So that worries me a bit as well. So I like the concept, but it's one of those names that you certainly want to be patient on. And I wouldn't be buying at these valuations unless it's just a pure momentum play. Well, that about does it for this episode of InvestTalk. Appreciate you all tuning in. And I thank you for listening and telling your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And if today's show made you think about your own financial picture, your investments, taxes, retirement, and whether it's all really working together, I encourage you to head over to our website and click on the portfolio review button. Go to investtalk.com, and we can help bring clarity and confidence to your situation. We can schedule a portfolio review call, go over your goals and concerns, and figure out what direction you should head in. Independent thinking, shared success. This is InvestTalk. Good night.